please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Global rating agency Moody's Investor Service raises the red flag on rising oil prices, says that higher oil prices could weigh in on India's current account deficit. In a chat with CNBC TV18's Ritu Singh, William Foster of Moody's and Aditi Nayar of ICRA says that India is in a relatively better position to handle headwinds from the external front. ICRA adds that it sees growth at 7.1% for this fiscal. Here's an excerpt of that interview.
On a relative basis, obviously, oil is the main issue for India, right? Because as an oil importer, that's really weighing on the current account deficit, and that's not going to probably go away anytime soon necessarily. But India is in a much better position today than it was, let's say, in 2013 during the taper tantrum to be able to weather some of these external factors.
Recent statements from the finance ministry seem to indicate that there is a threat to meeting the fisc target this year. You know, last year for FY18, we've met the 3.5% fiscal deficit target. For this year, it's 3.3%, but there seems to be some pressure on it.
Our expectation is that the government is committed to achieving the 3.3% central government deficit target this year. There's obviously risks around that. I mean, on the revenue side, GST collections could slip from targets because it's really the first full year of implementation, and taxpayers are still getting used to compliance. And with regards to oil, the pressure there is really on the excise tax and the possibility that could be adjusted. But again, the government seems committed to that. They benefited from the windfall in the past, but that is a risk. On the expenditure side, we don't know what the formula will be for the MSP in terms of its final format. And as you indicated, you know, the pre-election spending could be a risk too.
Aditi, you think the 3.3% deficit target, we're on track to achieve it?
Last year was a great year for disinvestment. You know, it benefited from the ONGC HPCL deal. This year, we're not quite sure whether there is going to be any big ticket disinvestment in the same manner, particularly after seeing the Air India results. Telecom also, there could be some small slippages compared to the budget estimate based on our recent estimates. And even dividends and profits, you know, that was an area last year where we had quite a bit of shortfall in the dividend and profit numbers. So I think that's again something that we're going to be watching for.
What will trigger the next rating upgrade action for India, or downgrade, either way?
You know, moving forward, it's a stable outlook, fundamentally. I mean, this, you know, when you look at things, you know, the peer group for India, India is kind of now at the bottom of the new range. We expect it to be several years for the reforms that we discussed earlier to take shape and to really contribute to strengthening of the credit profile. And the most important factor there is on the fiscal side of things, as we discussed, of bringing down that high debt to GDP ratio more in line with the median of the peer group, which is, you know, which is 50. The peer group basically is 50% of GDP versus about 70% for India. So there's a big gap there. There's room for significant improvement that would still keep the rating at the current level.